New year, new opportunities. We're like 30 days away from 2025. And a lot of us, we like to improve ourselves close to the end of the year so we don't repeat and we don't miss out on the opportunities that we missed on this year. We don't repeat the same mistakes again next year. And all of us, mainly in the market, we go through the same phase. We all make the same mistakes. We all sell at the bottom. We all not buy stocks because they went up too much. We all take profits too early. We all kind of make those same exact mistakes. But the most important thing isn't not making mistakes, but is learning from them and taking self accountability so you don't keep repeating the same mistakes again and again and again. And that's why I put in this video, and it's mainly 10 most common mistakes that stock market investors make. And I promise it's gonna resonate with you because this is stuff I see in other YouTube videos. It's stuff that I see from you guys in the comments, on Twitter, everywhere. And it always makes me a little bit laugh because I remember my old self. I remember that I used to be there. I used to make the same mistakes. But then I just learn and you go beyond them. And then after a year or two, you look back and like, how did I do this? Why did I think this way? And you eventually get over them. But it's better to do it early. And I hope you maybe learn a lot of stuff in this video. I'm going to share a lot of stuff I've never talked about. It's going to be very helpful. And I really hope you enjoy it. Now, this is the first one, and it makes me a little bit mad. Some of that stuff, they make me a little bit mad, but it's fun. It's a funny one, and I used to do it too, so there's nothing wrong with it. And the first one is using past performance to predict the future. For example, I talk about a stock, maybe it's Pepsi, maybe it's some kind of other stock on YouTube, and I get those comments all the time. And I used to do the same thing. And it says, over the last 10 years, the stock returned an average of an 8% return. The S&P returned 12%. So this stock makes no sense. You would have been better off investing in the S&P 500. Who cares about the last 10 years? Who cares about the last 5 years? You're not investing in the past. You're investing in the future. Maybe something changed. The company is not going to be the same all the time. The companies change. You have a new CEO. You might have a change in the board members. You might have a change in the business model. You might have a new tailwind, AI, or something you didn't have before, or something else, or something that has changed with policy or whatever. So whatever happened before, like if a stock went up 50% over the last 5 years, and the stock went out 20%, the one that went up 50% is not a better stock than the one that went up 20%. It has no correlation with it because the past doesn't matter. It does not predict the future. What predicts the future is the fundamentals. And when you're analyzing the company, you make sure you're paying a fair price and you do your analysis, which I'm going to talk about a little bit. But looking at the past to predict the future has nothing to do with it at all. Like I talked about a stock called LNG, Cheniere Energy, and people told me, yeah, but in 2008, the stock went down 80%. So if we have a recession next year, the stock might go down 80%. So I'm not buying it. In 2008, that's like 20 years ago, not 20 years, like 15 years ago. A lot of stuff have changed with the company. A lot of things have changed with the company. It's crazy. But whatever happened before, it doesn't matter. No one cares about the last 10 years. What matters is now and in the future because the companies change. Some companies underperform and all of a sudden they outperform. Microsoft was flat from 1999 to 2016. 16 years of no return. Would that have made it a bad company in 2016? Of course not, because things have changed. And this is what you have to pay attention to. The past doesn't matter. What matters now and the future. And if you're looking at the past, you're trying to tell yourself that you don't know what you're doing and the market knows more than you do and you just want to ride whatever the market is saying. And it's a big mistake. And just don't look at the past. It doesn't matter. What matters is right now and the future. Okay. The second one, which isn't, is also another one. And this is a very common one I get, and it's been very recently. And this is mainly skipping because of high debt. And I put in the T because this is something that worries like 98 or 99% of investors because everyone wants a clean balance sheet. And for example, I talk about Pepsi and say, oh, but I'm worried about the debt. And I talk about McDonald's, oh, but I'm worried about the debt. It's a legit concern. You have to worry about the debt. The debt is a concern, of course. But not all companies with high debt are bad. And not companies with high debt are the same. For example, if you have a boat company, and this boat companies, they sell low-end boat, not yachts or anything crazy. They sell like low-end kind of boat, or let's say an RV company. And the RV company is very cyclical. Free cash flow goes up and it goes down. It goes up and it goes down. It's very cyclical. And they have a very bad credit rating. So if they refinance, it's going to be a very high interest rate. And it's just a terrible company in general. They do have a lot of debt. Okay. Now, conversely, you have Verizon. with a predictable business model of telecom. You cannot get any more predictable, any more recession resistant than telecoms. And let's say they have a good credit rating and they have maturities out 20, 30 years at very low interest rates, and they can refinance this debt anytime. Now, would the RV company with high debt be as risky as Verizon, or would Verizon be as risky as the company with RVs that has cyclical business model, that has a low credit rating? Of course not. So the main thing is, let's say, for example, Pepsi. If you're worried about the debt of Pepsi, then I don't know what to say. Because Pepsi has an amazing credit rating. They have a telecom-like business model, recurring cash flow, pricing power, long-term maturities. They could refinance to that. Those companies, they should operate with a lot of debt. If Pepsi, McDonald's, Procter & Gamble, Verizon, if any of those stocks has no debt, I don't even want to own it, because the management would be stupid not to use a lot of debt. So some companies are made to use debt because of the business model, because of the credit rating, because of the long-term maturities. They can get a low interest rate. So not all high debt companies are risky. Some of them, they have to use high debt, and it would be dumb not to use a lot of debt to leverage up the business model and make high returns on equity. That's the way it is. So when you're looking at a company with a lot of debt, don't just skip it because it has a lot of debt. Look at the business model, if it's cyclical or not. Look at the credit rating. If they have a good credit rating, they could refinance or not. And just look at the company in general, long-term maturities. You can find them on the 10Q. I talk about them on YouTube. And this is what you have to look at. But if you skip a company because it has high debt, then you're just completely doing it wrong. And if Pepsi has a lot of debt, it's not the same as a boat company or a RV company having a lot of debt. And this is a big mistake that a lot of investors make. The third one, which is a very common one again, is I would say, 15% growth equal 10 PE. 20% growth equal 15 PE. And this is something that people believe, where if the company is growing at 20%, it has to be trading at 15 times earnings. Or if it's growing at 10%, it has to be trading at 12 times earnings. There's none of that stuff in the market, because every company is different. If it's growing 15, it does not have to be trading at 10. What determines if 10 or 15 or 20 times is fair is the margins of the company, the management, the quality of the business, if it's cyclical or not, if they have a good balance sheet or not. So a lot of people like easy answers where, for example, 15% growth, it has to be trading at 15 times. If it's trading at 20 times, it's overvalued. If it's trading at 30 times, it's overvalued. But if they have higher margins, that's different. If they have a better business model, if they have long-term tailwinds, if they have an amazing management team, you have to take all that stuff into consideration. And just valuing stocks based on gross MPE is a lazy way to value stocks. And again, you would miss out on a lot of stocks if this is all you pay attention to. It's much harder than that. Investing is not easy. You'd have to look at a lot of different things, including margins, the management team, and many different things. This is number 4. And I would say this is by far the most common one amongst most retail investors. Is the first question I get, what's the moat? I talk about, what is the moat? They have no moat. What is the moat? It's not just about a moat. The company does not need to have a moat. This is what people don't understand, is they believe that if a company is a high quality company, that means it's a good investment. If it's a terrible company with no growth and with high debt and with low margin, that means it's a terrible investment. This is not true. It's not true at all. And Howard Marks said it best. He said, it's not what you buy, it's what you pay. And success in investing doesn't come from buying good things, but from buying things well. And if you don't know the difference, you're in the wrong business. If you buy the best quality company in the world, with the exception of Costco, because that's like a crazy one, trading at 60 times earnings. But if you buy a high quality company, like for example, MSCI was flat for like 3.5 years before it went up. But if you buy a high quality company and you overpay for it, I don't care what kind of quality company it is, you're gonna lose money or you're gonna suffer flat returns. Because it's not just about what you buy, it's also what you pay for it. Now, conversely, if you buy a company with no moat, but they have maybe 1 or 2 year contracts, they have some, even Monish Pabrai talks about buying that steel company at a PE of 2 or something, and he made like 200 or 300%, and he's invested in coal stocks, and he made good money on them, and coal stocks have pretty much no moat. So you don't need a moat if you're paying a cheap enough of a price. It's not what you're buying, it's how much you're paying for what you're buying. If you're buying the best quality ever, but you're paying too much for this quality, and all of a sudden you're in a market where quality isn't being valued as it is in this current market, you could lose a lot of money because you overpaid for something that's good. But if you underpay for something that's not too good, you can still make money because you just paid the right price. So it's not just about the moat. It's not just about, the quality of the business. It's also about the price or the value that you're paying for it. And this matters, in my opinion, much more than a company that has a moat. So it does not have to have a moat for it to be successful. Is it better to have a moat? Of course. But if you're paying too much for this moat, you could still lose money, or you could suffer, little to no returns, flat returns. And it happened many times. Even MasterCard was like flat for 3 or 4 years, before recently. And, this is what happens. And number 5, this is another one, is waiting for earnings before buying. So you look at a stock, you want to buy it, you're excited about it, you love the business model, but earnings are coming up next week. So you say, okay, I'm just going to wait for earnings. If earnings are bad or if earnings are good and the stock goes down, then I'm going to buy it. Fair, okay. You wait for earnings, the stock goes down, you buy it, okay? Then what you're going to do on the next earnings report? You're going to get out before earnings again in case the stock goes down? What if it goes down up 30% this time? Or what if it goes down 30%? So this whole waiting for earnings game is not smart at all. It's not the best way to do it. Because even if you enter, then what are you going to do on the next report and on the next report? Because you shouldn't be buying, stocks based on 1 or 2 or 3 quarters. You should be buying them over the next 3 to 5 years. And if earnings were so dramatic that it caused you to change your thesis on the stock, then that's a different story. Maybe you could move on from it, maybe you could do something else. But waiting for earnings just doesn't make sense because you're just scared of losing money and you're just not valuing stocks over the next 3 to 5 years. Because if you do enter, then what are you going to do on the next one? You sell and it goes up 40%. You say, oh, I wish I was in. You start wishing and hoping. That doesn't work. So waiting for next earnings provides very little benefits. That's just my opinion. Number 6, this is the hardest one for most people, is skipping at 52-week high. And this is something I used to do. And it took me 3, 4, 5 years to stop doing it. And this is, again, another one. For example, I give you some examples. Like this one, Mama's Creations. This is a stock I bought it at $1.74. It was up 77%. 77% before I bought it in 6 months. If that was the old myself, the old me, like let's say 5 years ago, I would have never bought Mama's Creations. Never, ever, ever. Why? Because the stock was up 77%. I would believe that I'm late to the party, and I'm like, what if the stock goes down? But then after a few years of me missing out on amazing stocks, I learned that it doesn't matter. It doesn't matter if the stock is up. It does not matter if the stock is trading at 52-week high. What matters is the value and the future of the company. Because if the stock is up 77%, but EPS is up 100%, the stock could be cheaper now than it was before it went up 77%. And this is something that's very hard for a lot of people to understand, because when you look at price, you could track it. It's easy to look at. It's easy to get influenced by. But there's no chart of the intrinsic value or fundamentals. And this is when you need some kind of confidence, some kind of experience to be able to buy that stuff whenever they're up. And that's one of my best gainers ever. I'm up 400%. I bought it last year because the company is doing the right thing. And over time, I was able to adjust to it and buy it. Another one was Bird Construction. I talked about it on YouTube. I bought it here at $16.90, $17. And people went crazy on YouTube. They say, why would you talk about stocks at 52-week high? You're not going to get any subscribers if you talk about them. It's insane. And that's how I was. That's the mistakes I made. I was that guy. I was that person. But then you learn it doesn't matter. The stock was trading at 8 times earnings, growing 50% in earnings per share. It doesn't matter if it's up 100%. No, it doesn't matter at all. So this is what you have to understand. The main reason why you're not buying at 52 weeks high is because you have no strategy. It's because you're scared of losing money. And I always try to tell people, if you're scared of losing money, you're going to lose money. That's how the market works. And instead of you worrying about that stuff, you need to have a strategy in terms of position sizing, which means okay, I like, for example, Bird at 17. It's up 100% and it's cheap, but it could go lower. So instead of me trying to time the market, I'm going to open a small position, okay? And if the stock declines, then this is good news for me because I can buy more of the stock at a lower price. And then you could kind of set up a strategy around buying in and buying out and averaging down. And this way you wouldn't be too emotional about a stock at 52-week high in case it declines and in case it goes up and in case it goes down and all the hopes and dreams, which aren't really strategies. So you need a strategy in terms of when to buy the stock and how you average down and sometimes average up, which is something that's very hard for a lot of people to do. But skipping a stock just because it's up, just because it's at 52-week high, is a big mistake, major mistake. And it's going to take you a few years to be comfortable with it. And that's what it took me. It took me 3 or 4 years at least to be comfortable buying stocks at 52-week high. But once you get comfortable with it, then your entire investment philosophy changes, because you're no longer looking at the price and you don't care about the past. You're focused on now and the future and the fundamentals of the company, which is really a game changer. Number 7, this is the one a lot of you struggle with. A lot of you told me about Hims and Hers Health. I talked about it. You sold it at 20, now it's sitting at 30. You feel dumb. And that's the comments I get. I get a lot of feedback, which I appreciate very much. And this is one, taking profits because it went up too quickly. And again, the main reason you took profits because the stock went up too quickly is because you believe the market knows more than you do. And you're scared of missing out on the gains you made. I would recommend that book. It's called 100 Baggers by Christopher Mayer. Just go and read that book if you want to do something for the new year. And this book really changed my mindset in terms of, why would I be so focused on those 20 and 30 and 50% gains? I bought the stock to make 1,000%, 2,000%, 5,000%, potentially 10,000%, 100 bagger. It's very, very possible. So why would I settle for that 20 and 50%? Why wouldn't I pay attention to the fundamentals and, just stick with the company, even though it looks overvalued, even though it went up too quickly? But if the fundamentals couldn't be better, was like Hims and Hers, and it's still trading at, was it like 40 times earnings, and it's growing earnings 90% or 80%, something crazy, then it still has a very bright future. And this is what I did with Mama. Mama, I held it from $1.74 to $9.25. I would have never ever been able to hold such stock being up so much, 400% in 1 year, if I wasn't trained by that book 100 Bagger to just think of the long term, because the company could still 10x from this price. So it could still go to $90, $100 per share. Why would I settle for 300 and 400%? If my thesis hasn't changed, if the company isn't extremely overvalued, why would I take profits because it might go lower, and all those emotional decisions? You have to get rid of them. So read 100 Baggers and just focus on the long-term thesis, 10 years out. If it plays out, how much could it be trading at? And if it's just, for example, let's say I believe Mama could trade at, $100 per share in 10 years from now, and now it's trading at $60, I would sell. I'm like, yeah, that doesn't make too much sense, because if something goes wrong, then I'm in trouble. But if it's still trading at 9, and I believe it could go to 100, why would I be selling it just because I'm up? This is the whole thing. It's really dumb if you really think about the logic behind it. But we tend to not think of logic and make emotional decisions, and that's what it would lead to. So try to look at the book 100 Baggers and just look at the fundamentals and stop selling stocks because they went up too quickly. Unless they just got crazy overvalued, then maybe. But if they still have a bright future, why would you sell them and pay taxes and try to find another one? It's a big hassle. Just buy and hold. Sometimes the best stocks, you just have to hold them. And number 8, which is not a big one, but again, mainly a lot of new investors, and it's not taking a loss or just DCA. And this is something I found with a lot of people that joined my group. And whenever they watch YouTube and all that stuff, it's all about just DCA, just dollar cost average down. You bought Walgreens, it's going down 90%, just dollar cost average down. You bought some kind of other terrible stock, and it's been declining so much, just dollar cost average down. One day you sell it break even and everything is fine. This is not the right way to do it. And if you do it, again, Peter Lynch said it best. He said, selling your winners and buying your losers is like cutting the flowers and watering the weeds. I mean, this is a very dumb strategy. I'm just being honest. And most people, in my opinion, for some reason, they're scared of losing money. They're terrified. In my group sometimes, and I'm going to share some trades with you guys at the end of the year, I do it every year. Sometimes I have to take a loss. Things don't work out, the stock isn't working out, the company or the thesis of the reason why I bought the stock, the reason has changed. Why would I still be holding it? So I take a loss and move on. And people, they open their eyes like it never happened to them. They've been investing for 3-4 years, still bag holding WBD, still bag holding, all these stocks that it was clear that the thesis is no longer the same. But they held them because they don't want to take a loss, because they want to make it back with the same exact stock. It's something I never understood. I buy the stock because of a certain thesis. If the thesis changes, I sell immediately and move on. If I'm down 5%, 10%, 15%, 20%, I exit and I don't hold and hope it goes back to break even. I take my money and I buy something else that I have conviction in, and I could always make it back with another stock. You don't have to make it back with the same stock. That's what I did with WBD before. I sold it in 2022 around 13, then I got made fun of when it went to like 15, and then it went to like $6 or $5. Now it's sitting at 10. But it's 2022. I bought Google back then at, was it like $86 or something crazy, But this is another one recently was CVS, or it was mainly, in last year. I have one this year I'm going to share, but CVS is one. I bought the stock based on the management's guidance over the next 3 years. And then, they came out with guidance, they lowered guidance, and there were a lot of weakness in the business. And I noticed that the trend wasn't the way I was expecting it. And the management was too optimistic about guidance, which I ended up being right because they revised guidance 4 more times. And I noticed that the reason why I bought CVS wasn't the same. So I sold the stock pre-market. Before even the market opened, I didn't even want to do anything with it. I sold it, I think I lost 5 or 6%, and I just moved on. And people back then, they left my group because they saw like, oh, I took a loss. Like, wow, that's something big. They never did it. So this is what I'm trying to explain, is holding and hoping and averaging down on stocks like Walgreens and on stocks, that any stock, that if you bought it for a reason and the reason changes, holding it to get back to break even doesn't make sense. What I do is I exit, I correct my mistake early, I learn from what I did wrong, and I just take the loss, move on, put it in something else, and make my money back with another stock. You don't have to make it back with the same stock. And this is something that's very hard for people to do, but it's a very essential skill that not a lot of people have. And this is a very important one. Number 9, which isn't the best one, but it's buying or selling because someone did. So people tell me, Warren Buffett bought the stock, so I'm buying it too. Michael Burry or Bill Ackman bought the stock, so I'm also buying it. And you have to realize that those investors, they also make mistakes. Ackman sold Netflix at the bottom. Buffett took losses on Paramount and airlines. And we all take losses, like we all make mistakes. And you cannot borrow conviction. I always say it, you can't borrow conviction. So if you buy something because someone else did, you're not going to have conviction to dollar cost average down. You're going to sell at the bottom. And, it's a bad idea to just copy someone without knowing what you're trying to do, without knowing the thesis, and you cannot borrow conviction. And this is a very important one. Number 10, which is a little bit controversial and it's going to get me more dislikes than likes, but I have to talk about it, is, this is a big mistake, is not being open-minded. Because this is something I noticed amongst a lot of people on X, on YouTube, is we have different kind of cults, different kind of groups. We have the growth investors, then we have the value investors, we have the technical analyst traders or whatever, then we have the quality investors, then we have like 6 or 7 kind of groups, and they all make fun of each other. The value investors, they envy growth investors because they made money on hymns and Palantirs. They call them pieces of trash. Instead of trying to learn what did they look for to find Palantir. Maybe Palantir is overvalued, and I agree it is overvalued, but maybe you could learn from that person, what did they look for to identify Palantir? What did they look for to identify Robinhood? Or what did they look for to identify HIMS, which I own? It's up like, was it 280% this year, so 170%. But try to learn you're not going to lose anything. Like if you're a deep value investor and you believe that your strategy is the best strategy ever, and maybe you're right, maybe your strategy is the best, but try to find out what did they look for. Maybe you could learn something. Like this is what people don't understand, is the main way I was able to learn all the stuff I learned, which I do a lot of stuff. I do some options sometimes. I invest in growth stocks, value stocks. The main reason I was able to do it is because I was open-minded. Whenever I find someone that knows something more than I do, I used to shut up and listen. I'm just, show me what you know, like show me what you could do. Maybe I could learn something and implement it. Maybe you don't know what you're talking about, but the best way to find out isn't to make fun of someone else, is to try to see what they're about, and then you could make that decision if they really have something valuable, or if they're just trying to scam you out of something. And it's something that's very important, and it's something that we don't have in the investment community, and this is again something I experienced too. Like, I share my returns on YouTube, and people say, oh, but you don't share the year-to-date return. So I started doing it. And then they say, oh, but you don't share us, timestamp trades. So I started sharing timestamp trade. Now they want something else. And then they tell me, yeah, but maybe you're a trader. That's why you're up 60%. I'm an investor, and I'm in whatever country where they pay 50% tax. So if they did the same thing I did and they paid 50%, they would have made 30, but their current return is 35, which means they're outperforming me. This is insane. This is all, again, all about envy, not trying to learn from each other, not trying to see what kind of stuff we could learn and what kind of stuff we could implement. And that's what I try to do. And that's why I have my group. So I try to help people with that stuff. I don't sell courses. I don't sell books or anything. I do everything in real time. And I show you all that stuff, buying stocks, taking losses, doing profits, doing all these things in real time. And I think it's very valuable. So I really hope you enjoyed this video. It wasn't financial advice. Hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.